President and Portfolio Manager of the Permanent Portfolio Funds. Harry Rady, CEO and Portfolio Manager at Rady Asset Management. Steve Masocha, Managing Director, Wedbush Equity Management and Portfolio Manager for the Wedbush Hedged Dividend Fund. Steve Masocha, I want to go to you first. What's the moral of the story? Don't fight growth, don't fight manufacturing, don't fight profits, don't fight the stock market tape. How do you see this? How far is this going to go?
You left the Fed out, Larry. Don't fight the Fed. And the Fed's providing lots and lots of liquidity, and that's certainly finding its way into the stock market. It's finding its way into the economy, and things are improving. We're coming off the bottom very, very hard here, and I think we're going to continue to go higher. I mean, I will caution that we've had a very lengthy, consistent run. We may see more days like Friday now. We're susceptible to bad news, but clearly the economy is getting better. Clearly corporate America is getting better. Clearly, in my mind anyway, this is going to lead to higher stock prices over the next 6 months to a year.
So, Harry Rady, I could add a few other don't fights. Don't fight the repeal of Obamacare. Don't fight low tax rates. Don't fight budget busting or budget cutting, in Washington, D.C. What's wrong with this picture?
You know, I think that I need to be the voice of reason or caution. You know, the market has gone straight up, and we can't extrapolate. You know, we could be like Icarus and get burnt in the sun. So, you know, look, there are still some cheap stocks out there. The economy is certainly recovering. Corporate earnings are looking good. But the market may not be adequately discounting the unexpected. And I think the best way to protect yourself is to own the VIX. You know, the options market is giving away the ability to protect your portfolio.
Michael Cugino, one of the unexpecteds was, of course, Egypt, but the market has dis-Egypt. And as tensions have come down, the oil price has come down. And prior to that, gold was trending lower. So let me just ask you, you've heard all the conversation, you've heard all the what's wrong with. What's the glitch in the story, all right? You want to be sober, you want to be realistic. Where's the glitch, Michael?
Realistic, Larry, there's all questions. Markets never just go up. So, I mean, expecting the perfect world is kind of crazy. You know, all the points that are mentioned are legitimate concerns going forward. The market has run up quite a bit in a short period of time, the last 6 months or so. So consolidations, corrections, sure, they could happen. But I think the underlying economic activity levels are improving. The data points are improving. Look at the ISM number today. Corporate profits are still strong, providing a great underpinning to stock values right now. Dividend yields versus bonds are favorable. There's still a lot of cash on the sidelines. So, yeah, there's risks. I mean, you got to pay attention.
Yeah.
I think that
we're gonna fix your audio in just a minute. Let me go to Steve Masocha. Steve Masocha, you saw this blowout ISM number. It hit 60. It comes across the tape. The market reacts to it immediately. Everyone's talking Egypt, but ISM is what really mattered. Now, I want to ask you, the best sector, industrials, the second best sector, commodities. I need to know where to invest. I know that corrections come and go. I'm not really interested in corrections. I need to know about strategy for 2011. What did the ISMs tell you today about the economy and profits and all the rest?
Well, it tells you the economy's improving. It tells you manufacturing's improving. You know, in my mind, that's going to start to spill over to jobs. That's going to start to spill over to real estate. So I would look for areas that are still cheap. I mean, one of the areas I still think cheap, I think there's a lot of companies out there that are paying very high dividend yields. I think there's still a tremendous yield to be gotten in the equity market. That's going to drive stock prices higher as investors see that and try to get some kind of return on their money, especially where interest rates are today. So, yeah, manufacturing strong. Yes, extraction, be it oil or mining, is strong right now, but it's not going to stay contained to those areas. It will spill out. It will spill out to where it always spills. Finally, real estate will come back. The jobs market will come back. All of this is going to get better. And a lot of it's being prompted by the fact that there is tremendous liquidity out there. The Fed has been incredibly accommodative, and that is starting to have an impact. Surprise, surprise.
Let me go there. Harry Rady, don't fight the Fed. That's a common street wisdom, and I'm sure it's true. But if the Fed looks at this blowout ISM number, and then it looks at its cousin, the ISM prices number, which hit 80, all right? And 80 is the highest since 2004. Now, we're going to have a full-fledged inflation debate later in the show, but what I want to know from you is the Fed in danger? Is the market in danger that the Fed might pull back its liquidity adding and its QE2 simply because things are so much better than folks expected?
Oh, I don't think so. You know, things are much better on Wall Street, but on Main Street, the consumer is still struggling with a very difficult housing market. And, you know, for most people, their home is their largest asset. So I don't think you can lose sight of that.
But how is the Fed going to affect housing prices? That's something I've never really understood.
With interest rates.
With interest rates, which are zero. And
Right.
by
So-
the way,
so-
and if mortgage rates, which have gone up already, if mortgage rates continue to edge higher, wouldn't that be a signal to people that they ought to start buying right now because their incomes are rising and 90% of the workforce is working and wages are rising? Wouldn't that be a signal? I mean, maybe the Fed is playing its cards all wrong.
Well, theoretically it could be, but the reality is if interest rates moved up, if mortgage rates moved up, it would make the cost of ownership more expensive. So I think the proof really needs to be in the pudding. And until house prices across the board really start to move up quarter after quarter, you know, this enormous shadow inventory is a real issue. I mean, there's a good 2 years worth of inventory, and I just don't see how house prices can move up with that much inventory. So with that as a backdrop, we want to own companies that won't be affected. We want to own companies like Celgene, world-class biotech company trading at 16 times earnings. People are going to take their medication irrespective of the housing market, and their pipeline is just completely underappreciated.
Michael Cugino, when's the Fed going to take its medication? Because, look, the Fed can't control every housing market. That's a local
yesterday,
issue.
Larry.
Yeah, yesterday. They're on the wrong meds, the Fed. I mean, you see these numbers coming out. Let's stay with the ISMs today. The manufacturing sector, surprise, 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 it is actually leading the recovery. And so are the industrial and commodity-type stocks that go with it. Why should the Fed continue to wait? Harry Rady wants the Fed to bail out every homeowner. I don't. When does the inflation rate and when does the strong growth rate, Mr. Cugino, stop the Fed's pump priming?
Well, I think the inflation train has already left the station. We're starting to see some of that throughout the world in inflated food prices and some of the social unrest that invariably follows a deflation of a currency. So that I think that's a problem down the road. It's not an issue right now. But I think yesterday, you know, I'm not kidding. My view would be that the Fed, QE2 has limited benefits. There's too much liquidity already. A lot of it's sitting on the sidelines right now. You don't need to create any more. You got to get the velocity up of what's already been created. I also think it wouldn't, you know, we're living in a very unusual time with 0% Fed fund rates, basically. It's not a normal time. So let's get back to normal. Let's increase short-term Fed funds rate a little bit, get back to normal, maybe help support the money markets, and get back to a more normal, you know, economy and have rates go up commensurate with the growing economy.
Steve Masoka, do you worry that the dollar exchange rate is falling again?
Well, a little bit, but Larry, I mean, we talk about housing, just to go back there for a second. I think we're leaving an important factor off the table. We haven't built this few homes since we've been keeping track in 1957. Look at a chart of housing starts. It's off the charts going down. We are building no homes in this country. Apartment prices, there was an article in the Wall Street Journal this weekend about how apartment building prices are through the roof, back to 2007 highs. Rents increasing across the nation. This is going to break. I mean, all of the signs are getting ready. In my opinion, the housing inventory is going to start to get cleaned up, and housing prices are going to head back higher. There's no supply. The supply is not being added.
What are you saying, besides the fact that Harry Rady is wrong? What point are you making, Steve?
Well, I think Harry's right today, but I think 4 or 5 months from now, Harry's going to be wrong. He's right today. There's a lot of inventory. Prices are very low right now. It is a drag. But I think the signs are there that in 4 or 5, 6 months from now, the housing market's going to get a lot better just from pure demand and supply. So and going back to the current...
no, go ahead. Address the dollar, because no one's talking about the dollar starting to creep down again.
The car is starting to creep down again. That's because confidence has come back to the euro. You know, you get one more little wiggle in Spain or Portugal and Italy, or another wiggle in the Middle East, everyone's going to come piling back into the dollar again. It's going to be the safe haven. So all of the Cassandras, they were talking about how QE2 was going to kill the dollar 4 or 5 months ago. Well, the dollar hasn't been killed. The fact of the matter is the economy needed this liquidity. We're getting better now. The real test, and I know you're a critic, Larry, but the real test will be when the sop-up operation needs to happen. When do we need to get back in and clean up the
trying to
cryptocurrency.
get a straight answer from you guys about the sop-up operation, because I think
Not yet.
I think the stock market will worry about the sopping up. Harry Rady, do you want to defend that point of view?
I like to defend my point of view on the housing market. I just don't know how, with 2 years worth of inventory, I just don't know how anybody can expect the housing market to recover in 4 or 5 months. I mean, maybe a year from now, more likely 2 years from now, because in addition to the shadow inventory, when we see prices start to tick up, there's a lot of people that would love to sell their houses where it's shadow inventory.
All right, we're going to have to leave
Well,
it
you
there.
know, Larry, I would also say that one point
Real
with
fast.
housing is that I think structurally banks are still a little bit unwilling to lend, and that lack of liquidity is also affecting. I mean, there's plenty of supply out there, but if people can't get loans and transact, then that's going to keep a lid on transactions.
All right, I'm more
Agreed.
interested in when the Fed starts sopping up and what that means for the
Yesterday.
stock market. But we're going to have to put that off to another day, gentlemen. Thank you, Michael Cugino, Harry Rady, and Steve Masoka. Coming up on
Excellent.
Kudlow, manufacturing prices paid growing like gangbusters.